This video, we're going to work exercise 14-7. 14-7. Lumpkin Company sells lamps and other lighting fixtures. The manager prepared the following inventory purchases report. Policy is to maintain ending inventory equal to 10% of the following month's cost of goods sold. April budgeted cost of goods sold is $40,000. All right, so let's talk about what's going on here. I think it's helpful to do an extra step that isn't required, and I'm going to put that right here. Let's reflect April. So in a prior video tutorial, I created one where we needed a month here. Sometimes we'll need a month here. Sometimes we'll need them both, okay? All right, even though it's not included in the template or the information precisely given, and you don't have to work it the way I'm doing, but it's good illustration purposes to get everything going. So it said April budgeted cost of goods sold is $40,000. When I say getting everything going, I'm talking about the learning process. We're pretty well done with April now that we've written it. That's what I'm saying. You probably didn't need to write it, but I think it helps to visualize things. All right, so it says that balance equals 10% of the following month's costs. Well, desired ending inventory for January, 10% of $32,000 for February is $3,200. So 10% of $35,000 of March will be February's ending or desired ending inventory. And if we hadn't written down April, we'd be going, what? Where do we get March's desired ending inventory? Well, we see it right now. So 10% of $40,000. So now we see the reason we wrote down $40,000. For April is so we could easily come up with a desired ending inventory for March, which is 10% of the sales, budgeted sales for April. And again, you don't really need this. And maybe in the real world, we wouldn't have put that there either on our budget. It would have looked more like what's in the green here. But for teaching purposes, I think it's easier to see. All right, so now we just total up $32,000 and $3,500, and we get $35,500, and we do the same for March, obtaining a number of $39,000. Now, ending inventory is calculated, but when we end January with $3,200, that becomes February's beginning inventory. And the same thing for February. When we end February, $3,500. March's beginning inventory is $3,500. So that's $3,200 for February and $3,500 for March regarding beginning inventory. These are really subtractions. And it says less here, so you don't need the parentheses, but I do this for teaching purposes to make it pop off the page. So we have 32,300. I'm writing, I don't want the really dark line there to cover up my numbers. And then the answer for March, the answer, right? That's what we're after is required purchases, 35,500. Let me add my own little dark lines. Okay, so those are our answers for A. We're done there, which is good. Now, B says, determine the cost of goods sold. The company will report on its first quarter pro forma income statement. Again, as you have learned, pro forma is basically our operational statements, balance sheet, income statement. So it's asking for part of the income statement, the budgeted income statement, the pro forma. So this income statement versus a balance sheet. An income statement reflects changes over a period of time. So the period of time is first quarter. So over the first quarter, what was our cost of goods sold? Budgeted cost of goods sold. Okay? And that will be the total right here, this line. So it'll be a total of 30,000 plus 32,000 plus 35,000, and that will be 97,000. All right, so again, I'm going to write down income statement here, or I'm going to write down the abbreviation for income statement to denote that that is a period of time. Income statement. A balance sheet, it's a snapshot of now. So a balance sheet for the first quarter will be what was the balance on the very last day of that first quarter. Not what happened during the month. No, that's other statements. What we want to know on the balance sheet is tell me what you got right now, if you will, if you don't mind me using that kind of terminology. So what's it look like right now? So imagine just taking out your cell phone, taking a snapshot, and now you got a picture right now, just then, that moment. Well, when we go to that level, then when we're looking at the amount of ending inventory, we're looking at the ending balance for March. So desired ending inventory, March, 4,000. Hopefully this video helped to highlight how we go and approach these problems and the difference between the income statement and the balance sheet. And to repeat again, the balance sheet over time. That's why we added up 30,000, 32,000, 35,000. The balance sheet is tell me what it is now at this very moment. Tell me the date and tell me what you got. So last day of fourth quarter, what's your ending inventory balance? 4,000. This concludes the video on exercise 14-7A. If you have any questions, please email me.